Hey guys, this is Lisa Church. I recently did a blog post on the importance of making estimated quarterly tax payments if you're self-employed. I'd like to take this a step further for those of you who are not only self-employed, but you also have employees. And if you are an employee, you're going to want to make sure that your employer is doing this for you, so stick with me. The focus of my practice in Severn, Maryland is to help taxpayers get in compliance with their IRS and state tax filings and to represent them before the IRS and the states with their tax collection issues. I work with individuals as well as business owners, and a lot of my business owner clients have employees. All right, remember those income and employment taxes that I mentioned being withheld from your employee paychecks in my last blog? Did you ever think about what happens to that money once it gets subtracted from your gross pay? This is a very simplified explanation on this chart showing federal tax withholdings, but basically the income tax portion is calculated based on the Form W-4 that was completed by the employee. This amount is funded strictly from the employee's gross pay, and the money is withheld from the employee's paycheck to cover the entire amount due for income taxes. The employment or FICA tax portion is funded by both the employee and the employer, with the employee's half being withheld back from their paycheck. The money withheld from the employee's paycheck to cover this income tax, as well as their share of the FICA taxes for the payroll period in question, is called withholdings. A net payroll check is issued to the employee after subtracting these withholdings from their gross pay for that payroll period. The withholdings are kept in the employer's bank account until they're remitted to the Treasury on a monthly or semi-weekly basis, depending upon the amount due. Sending these payments to the Treasury for taxes withheld from the employees, along with the employer's own portion of the FICA taxes, is called making federal tax deposits. There are other taxes that must be remitted by the employer, such as for federal and state unemployment, and there are other amounts that are subtracted from an employee's paycheck, such as for health insurance, but these withholding taxes are in a category all their own. They're also called trust fund taxes, since they're supposed to be held in trust by the employer until paid over to the Treasury. Employees trust that their employer is paying the amounts withheld from their paychecks to the Treasury by making the required federal tax deposits and by making them timely. Unfortunately, though, what should happen with those funds isn't always what happens in reality. One of the more scary situations that I've seen is where an employer doesn't have the cash available to make these monthly or semi-weekly payments. The pattern that most often plays out is seen in the following downward spiral. The employer can't make payroll and both make their federal tax deposit 1 month. So for whatever reason, there just isn't enough cash in the bank to do both, to both pay the employees their net paycheck that the employee is expecting and to send the income and FICA taxes withheld from the employees over to the Treasury. The employer chooses to only pay the employees that month or that week, since they've got to keep their workers, right? And they rationalize that no one will know. Thinking that next month will be better, the employer doesn't make the federal tax deposit. Then the next month comes and it isn't any better. So another federal tax deposit isn't made. The months add up and the employer now has an overwhelmingly large amount due. The IRS inevitably comes knocking because they actually do see when the federal tax deposits aren't being made. At this point, the employer is unable to hide the terrible facts any longer. The employees are sent home and the business closes. Borrowing from your payroll taxes by not making your federal tax deposits is said to be the easiest loan for a business to take, but the hardest to pay back. Not only is the business liable for these unpaid trust fund taxes, but the business owner themselves is personally liable. And it doesn't matter how the business is structured, whether it's a sole proprietor, partnership, S Corp, C Corp. Congress saw this issue as such a problem that it enacted the trust fund recovery penalty to encourage prompt payment of withheld or other collected taxes by allowing the IRS to assert liability against willful and responsible third parties, which would include the administrative staff person who's writing the payroll checks, if they can prove that they're willful and responsible. This is not a situation in which you want to find yourself as an employer. Just like with your income taxes due, however, the IRS is more than willing to work with employers on settling the amounts due for withholding taxes and for trust fund recovery penalties. My goal is to help taxpayers meet their tax filing obligations, to pay the least amount of tax legally possible, and to represent them when they have an IRS or a state collection issue. I've given you my contact information on this last slide. If you'd like to come by my office in Maryland or just like to call or email me, I'd be more than happy to help you with your tax issues. I hope you had a happy Thanksgiving, that you survived the Black Friday madness, and I'll see you here next time.